Okay, so we did this problem last time with straight line depreciation. What we're going to do now is use the Macker's 5-year schedule to depreciate it. This doesn't really change anything except the depreciation every year. So we just have to calculate, we use these numbers, as I said, to calculate the depreciation each year. I've done the calculation for you here, but we're just taking this percentage times the original cost. Right, and then everything else is the same in the problems, but you have to refigure all of the numbers because the depreciation has changed. Yeah, so you got to recalculate all the numbers with those new depreciation amounts, and I've got them here in the slide. So notice the savings is the same each year, but now since my depreciation is different, I have a new value of earnings before taxes, which is going to change the amount of taxes that I have to pay, which is going to change the amount of operating cash flow. And it's also going to be different every year. In the previous problem, since the depreciation was the same every year, then our operating cash flow is the same every year. That's not the case in these problems where we have these MACRS depreciations. Right, so you just go through the calculations. Now, I'll mention also here, we end up with more depreciation than we have savings in this case. And so we report negative earnings before taxes. Now, don't let that mess up your calculations. Just go ahead and calculate it as you would. The taxes in will be the tax rate, which in this case is 40%, times this number, and you're going to end up having a negative amount of taxes. Now, that may not seem to make sense, but really all it's saying is that you're actually saving money on taxes by being able to report a loss here. So you can think of it as this is just one part of your business. You've got other parts of your business that are making money. And since this is going to be negative, you're going to report negative earnings before taxes here. It's going to reduce the amount of earnings, positive earnings that you have to pay taxes on. So in other words, if I made a $10,000 in some other part of my business, well, because of having this loss of 420, I would have to report 10,000 minus 420 as actual profits to be taxed. So being able to have a loss here actually saves me this much money in taxes, $168 in taxes. So that's why we make it negative taxes. So again, just if you get a negative number here, a negative earnings before taxes, then don't let that mess you up. Just go ahead and calculate the number as you would, multiply it times 40% or whatever the tax rate is. Have the numbers negative taxes. Your net income then is minus EBT minus a minus taxes, all right? It's always EBT minus the taxes, which in this case, you're going to have minus a minus, so you're going to be adding this number. And so you're going to report that net income of minus 252. Okay? And by the way, this is a good illustration of what depreciation does for you. You can see the depreciation here. You actually end up reporting a negative net income, so it looks like you lose money in the accounting reports. So when the tax guy comes by, you tell him how hard it is to be in this business and you're not making any money and you don't have to pay any taxes on this part of the business. In fact, you save money in taxes by having this loss. But in terms of the actual cash flow you made over $1,500. You made even more than your savings. And that's because you were able to use that much depreciation, literally saved money in taxes, and you gained money from the taxes in this way. All right, it's just the way the accounting's worked up. It almost seems like it's illegal. It almost seems like you're committing tax fraud here, but you're not. You're just following the rules, and you actually make money off of the taxes in this case. Okay, so that small complication aside, then this is what you do here. You just calculate depreciation every year. Once again, savings minus depreciation is earnings before taxes. The tax rate times earning before taxes is the amount of taxes paid. And earnings before taxes minus the taxes is equal to the net income. And then you add back the depreciation to get the operating cash flow. All right, so there's all the numbers there. I encourage you to work through this and make sure that you can get these numbers on your own. All right. Okay, and then if we put these in the cash flow button, we'll have the same initial amount as we had from the previous problem, so the same cash flow 0 as in the previous problem. Then we'll have this as cash flow 1, 2, 3, 4, 5, and 6. And you should get a net present value of $136.63, which by the way is now positive. And that again just goes to show you how we didn't change anything about this project. It's no more efficient. The machine doesn't work any better in this case. Nothing has changed except the number we write down as depreciation on the accounting reports. But because we can depreciate more of it faster, it means that we save money on taxes earlier, and we end up having a positive net present value here, right? Now, if you look at the amount of taxes paid, if you add up all of these numbers, we pay the same amount of taxes this way as we do with straight line depreciation. You end up paying the same amount of taxes. It's just that you pay less early on. Doing it this way, you pay more of your taxes out at the end. And because we have time value of money effects here and we have a pretty high discount rate, that means we end up saving a lot of money here, enough to make it be positive, because we save more in taxes early and we pay the taxes later on, right? Versus the straight line depreciation problem. Okay, and so let's see here. Yeah, so this just kind of brings it out here. Straight line is a negative net present value. If we use the Macker schedule, it's a positive net present value, and that's because with Mackers we pay less taxes early on. We pay the same amount of taxes in total over the 6 years, whichever way we do it, but with the Macker schedule we pay most of those taxes out at the end. And because of time value of money effects and this high discount rate, it can actually turn that net present value positive. All right. Okay, and so that's the answer to this one. Why is accelerated depreciation, that is the Macker schedule, is also called accelerated depreciation. And the point here is that companies will, given the choice, they will almost always choose accelerated depreciation, because the answer here is D. It impacts favorably with the time value of money, right? It's not A, that it increases the total depreciation tax shield over the project's life. That's not true. You have the same amount of depreciation either way. It's just you depreciate more of it early on with the Macker schedule. It doesn't reduce the total amount of taxes over the life. It just reduces the timing of the taxes. With the Macker schedule, you pay more taxes out at the end than you do early on. It increases net accounting profits over the project's life. That's not true. You make the same accounting profits either way also. It's just with the Macker schedule, your profits are lower to start with and then higher at the end. Your accounting profits, not your cash flows, right? With Mackers, because you pay less taxes early on, your cash flows are higher at the beginning. You can see that here. Your cash flows are much higher early on, and then they get smaller out toward the end. But because of time value of money effects, you end up saving money that way. Right, so the answer here is D, saves you money. Okay, so I'm going to go through this problem in the next recording. Let me stop here and I'll pick up the next recording.